Erin, we had Rish giving us an overview of the markets. Lots to consider. We have the strong eco data out of the U.S. We have, the Fed saying that it will continue its stimulus because we're a long away from where conditions should be for the economy. We have oil above 60 a barrel. How are you weighing all of these factors?
I think the thing to really keep in mind is the growth trajectory. As we continue to see the economies reopen in the US and Asia, as well as globally, and as we continue to see virus concerns abate, I do think that this year the GDP outlook is going to be the best that we've seen in 10 years. And on the back of that, I'm expecting that equity growth will continue. And so while we're certainly bullish equities, we're really leaning more into the cyclical areas of the economy that we think are going to outperform this year.
But even as you say that, taking a look at yields, they're surging. At what point will it be breaking point for the equity market, for instance?
We're still, I think, a really long way from yields and the absolute level of yields really breaking the equity markets. While we've seen a 60 basis point move off the lows over the last 5 months in terms of the absolute level of nominal yields, when you look at real yields, they've barely budged. I mean, real yields have moved maybe 15 basis points off the lows. And so it's still a really constructive environment for equities relative to fixed income.
Can the Fed contain yields? Will it?
I think they can. I mean, I think that, certainly we've seen the Fed come out today quite dovish and really talk about the fact that they don't expect to raise rates anytime in the immediate future. They're probably unlikely to raise rates this year or stop tapering rather this year. And then raising rates will be a year after that. So while you can continue to see the 10-year and the longer part of the fixing curve sell off, certainly in line with rising inflation expectations, I think the front end is going to remain fairly well pinned.
Erin, it's Rishaad. So tell me, where does that leave you? You're overweight equities. Okay, the equity market is telling us one thing. What's the bond market telling us?
I think the bond market's telling you kind of the same thing. The entire move that you've seen off the lows in yields has been driven by break-even inflation expectations. So real yields haven't moved at all. It's been all about inflation. And that's quite a bullish sign, particularly for the more cyclical oriented, the more value oriented sectors of the economy. And so that's why you've seen a leadership change in terms of the equity move, where in line with increasing inflation expectations, you've also seen commodity-oriented sectors, more cyclical sectors start to outperform. And I think that that's likely to continue at least through the midpoint of this year.
Right, well, rising commodity prices, rising shipping prices. We've got a gamut of things at the moment which are pointing perhaps to inflation further down the line. But the Fed doesn't seem to be particularly concerned about it. And they're at pains actually to suggest that, well, they don't expect a spike in inflation anytime soon. The thing is, with the averaging of inflation expectations, et cetera, and inflation itself, how does that leave ultimately the Fed behind the curve should we see a spike anyway?
So we're certainly going to see inflation rise through the middle half of this year. And we expect that inflation is going to probably peak in the May, June, July timeframe. That's largely on the back of base effects. So headline inflation, may breach 3%. It's probably likely to. But from there, it's going to come back down. And we expect that inflation is going to end the year in terms of core PCE, which is the measure that the Fed looks at, below 2%, somewhere in the rough range of about 1.7% at year end. So inflation's going to rise and then it's going to fall. Sorry.
So, Erin, how does that dovetail in your view of where the dollar goes next and what that means?
Yeah, it's a good question. We've been short the dollar since the middle half of last year. We started off short the dollar relative to developed market FX, and then we shifted into starting to take on a little bit more EMFX exposure. I think from here, we're likely to see the pace of the dollar decline slow, but I still do expect that the dollar will weaken slightly versus emerging market FX through the middle half of this year, particularly as we continue to see commodities do well and as we continue to see that translate into, a more robust environment for EMFX, particularly with commodity exposure.
Erin, on the issue of inflation, no runaway inflation expected, but it could rear its head maybe in the second half or beyond. I mean, how do you seek refuge from inflation? Would it be financials? Would it be gold? Would it be copper?
Yeah, I think there's a couple of ways to approach it. And I do think you need a diversified approach. I think the first thing is being long inflation-oriented assets like cyclically oriented equities. I think that's really to give you sort of positive beta exposure to a rebound in inflation expectations. I think the second way is to be long real yields relative to nominal, because the sell-off that we've seen in yields has really been driven by inflation. So if you're long inflation break-evens or you're long real yields, that will give you exposure. I think the third way is to be long commodity-oriented stores of value like gold, and that's a real good complement to a risk-on portfolio, being long equities in your portfolio. So, I do think you need to approach it through a diversified sort of area, but I think all three of those offer good stores of value and exposure to a rise in inflation expectations. But we don't think that inflation is going to be runaway, as you stated.
Are you liking Asian dollar bonds? Could that protect you from yields?
Yeah, we really like Asia dollar bonds right now, particularly China. And we think that they offer, first, a really good diversifier across your portfolios. They're sort of negatively, have a good negative correlation to corporate bonds as well as to equities. Secondarily, the relative yield differential that you get is really attractive right now, and has widened out pretty significantly since the midpoint of last year. And I think right now, dollar-denominated Asia bonds is one of the most attractive investments that we have in our portfolio.
Erin, tell me, are you fully vested right now, or do you have any cash waiting on the sidelines?
Yeah, we tend to be fully invested, and we invest our cash in short-term, sort of high-yielding investments, at least on a short-term basis. But we think that being fully invested right now, makes sense. And we do see very attractive opportunities on a global basis, although we are having to dig a little deeper and look a little harder than certainly 6 months ago.